Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. If you guys are looking for undervalued investment opportunities, click subscribe. We talk a lot about it. We talk about inflation, deflation, all sorts of stuff. So this one, I'm going to talk about the real estate market. And I'm seeing a lot of YouTube videos coming out and saying that we're going to have this crash and it's 100% like it's in the bag. I don't think it's in the bag. I think they're wrong. I think all these guys are wrong. I'm going to give you my viewpoint. Doesn't mean I'm right. I'm going to give you my viewpoint. I'm going to give you some history and why I think that we are not going to have a crash and that we're not even anywhere near a crash. And what you have to look at in a real estate cycle, and remember, this is what I'm basically debating is inflation versus deflation. So these guys that come out with the deflation call are basically saying that our real estate market's going to crash. That's basically in a backhanded way saying, oh, real estate, like it doesn't matter. Real estate is the gateway for money to get into the system. That is residential real estate. That's the majority of the loans that are made at commercial banks. It's over 50%. All that cash that gets loaned into existence at ever greater quantities, because if you have an increasing real estate environment, it's getting loaned at larger and larger quantities, which is inflationary. It'll increase the M2 money supply. Now, what can we use to gauge the health of the real estate market? It's days on the market, inventory, and we can look at real estate housing starts. So when we look at the real estate housing starts, you're going to lose me here. This is the real estate housing starts for residential real estate. If you look at when we get to about 1.5 million, 1.4, 1.5, somewhere in that range, is the average yearly demand for homes that are being built. Now, when we go down, we have a deflation. We have a contraction in the money supply, and it ends up in these dark gray lines, which is recessions. Every time you go down, recession. You come down, recession. You come down, recession. And notice how the housing starts have to go down for a while. This one, it flattened out, then started to head down, and then we had the deflation or recession, the deleveraging on it. Then we have a go down, recession, down, recession. We had it go down for a while, recession. So these things, basically what I'm saying is that the housing starts is a leading indicator of when we could have deflation or a deleveraging. So you've got a boom on the front side, which is an expansionary phase of real estate, which is an increasing money supply, booming or expansion of credit. On the back side is a deleveraging deflation. Now, if you look behind me in that housing starts, right here, all these dark gray lines that you can see here, all those lines there, none of them are randomly placed in an expansionary phase. They're all at the end of a decline, all of them. If you notice, the only one that's not is the 2000 bubble, NASDAQ bubble, and it wasn't really even a big recession. It wasn't a recession for housing. We didn't have a blowout deflation. They called it a recession because the stock market crashed, because it was so overvalued and interest rates started to move up a little bit on them. Now, here's another thing. Every single expansionary phase, every single boom in housing and real estate has a paired increasing interest rate environment with it. Interest rates are the lowest when the housing market crashes in a deflation. Everyone piles into bonds. Everyone sells bonds when real estate goes higher. So you don't get a real estate market going up. You will have interest rates go up with it. They go in lockstep up. Housing starts do this, and then interest rates follow as the inflation comes into the system. I don't think that you could have that go any other way. So when people talk about this deflation that's coming, it's not possible to have this blowout deflation until we see the real estate market turn. Look at history. Look at all those recessions. They all happened after the housing starts declined, except for one. The real estate market, the housing starts aren't declining. In fact, if you look at inventory of real estate market, and here's the real estate market inventory. This is the U.S. existing home months in supply. This is 10 months up here, where it's really, really high. And down here, it's 3 months. That's Actually, it's 1.9 right now. This is a little bit old of an article. We're at 1.9. This is what happened in the last bull bear market of real estate. So the cycle came up and we had a very low inventory of homes all the way to 2005. The inventory skyrocketed all the way to 2007-ish. Then that inventory at 10 months of inventory caused a crash when all of the foreclosures, all of the housing, new homes that were being built because we were overbuilding in that time period, they all came onto the market and created a 10-month inventory of homes and crashed the market. This is with 10 million delinquent loans on top of it. So they dumped 10 million delinquent loans, and we overbuilt by millions of homes during these years because we were up over 2 million homes. We can show you that. It was at 2.273 million in 2006. So we overbuilt. The housing starts declined rapidly before the crash in 2008. And our inventory showed that we had massive inventory. Now, we have people saying that we're going to have this crash. We are at all-time lows on inventory. We haven't built any homes in an expansionary phase of real estate. I showed you on the real estate. If you look on the right-hand side here, see this? We haven't built enough homes. They don't exist. They don't exist. I don't know how we can have deflation from real estate. If real estate's the driver of inflation and deflation, I don't know how we can have a crash in real estate if we're at the lowest point in housing inventory ever. How are we going to reverse this? We need to get to 10 months. If we want this big blowout crash, we need to get to 10 months. And guess what? That's going to take years to get there. And that's if we have a problem. What if we don't have a problem? The 05-06 crash, we built the homes, we had the homes built already, and we had foreclosures come on at the same time. It was a double whammy. Now, we don't have any homes. So literally these people are saying that we are going to have a deflationary crash, that real estate's expensive, and we have no homes to create this deflationary deleveraging. They don't exist. So I am struggling, and I keep doing videos on real estate because everyone's pumping this stuff out there, and I totally disagree with them. Real estate has to go higher. It has to go higher in order to balance the market. And these people, they're talking about interest rates. Interest rates aren't going to affect this. This is a supply-demand balance problem. Interest rates are not in that supply and demand equation, even though I think some of you guys think that it's going to affect the demand. I don't think so. That's not what history has told us. History has told us that when you get into supply-demand problems, that you have to build your way out of it. And if you don't build your way out of it, prices will continue to go up irrespective of interest rates, because interest rates chase inflation. And if you look at the logical conclusion that people will draw when they go to buy a home, they'll say, oh crap, we've got inflation coming that's pretty bad. I better get in a house and lock in my costs because it's going higher. I don't know where this thing's going to peak. And most people, they don't know the real estate cycle. They don't know this stuff. But you guys do on this channel. You are now privileged to information that's going to make you a superior investor. Because if you know this cycle, you know where to be. If you're in an expansion phase of real estate that's inflationary, if it's inflationary, you want to be in commodity type companies, precious metals, all those types of things. If you're in a recovery phase of real estate, which is a recovery phase is when you're below 1.4 million and you're building more homes and you're recovering. That's a low inflationary environment. So you're going to have low interest rates, low inflation. Stocks kill it. Stocks kill it in that cycle. Then, when you go into a hyperinflation or hypersupply phase in real estate, and you see the housing starting to decline, a deflation is coming. A market crash is about to happen. You position in bonds or cash. Bonds would be the preferable area. Cash would be the second. Then you're going to get this blowout of everything crashing. When everything crashes and you're in bonds, when you hit that bottom, you rotate your bonds into stocks. Stocks, you rotate it into commodities in an expansionary phase of real estate. Now, this cycle, it comes and it goes, and it's pretty predictable, and it's not very fast. You get a year or two window to buy and sell and cost average out, cost average in into whatever you want. Things don't happen in months or days. It's too fast. So these guys that are calling for a crash in real estate, I'm afraid to tell you, but they don't know what the heck they're talking about. They have no idea. I wouldn't listen to them about anything because the market doesn't move that fast. That's like saying we're gonna turn this Titanic ship in 5 feet. You're like, there's no possible way. It's designed and is so large it physically can't do it. The market is at so low of inventory numbers. There's going to have to be a flood of inventory come on. And I don't know even if that could do it. I don't know if the moratoria ending, one, we don't know what the inventory is coming from that. We don't know if people are going to sell their homes. We don't know what the dynamics look like there. No one knows that. They just made up all these numbers. And even if that did hit, I don't know if it's large enough to have a large impact. It might slow down the market. I don't think it's going to stop it. We're just exchanging ownership in that type of scenario. We're not actually fixing the root structural problem, the supply-demand problem. So be careful who you listen to. I'm doing these videos. I know it seems like it's over the top for real estate, but real estate is the driver of everything. That's how important I want to make this clear to the people on the channel. It drives rotations of money between assets because it drives interest rates. Real estate is the key. So if you guys like this content, give me a thumbs up. Thank you for listening. This is Finding Value.